Connecting with investors and building your financial network. Are you ready to make the leap and take your business to the next level? If so, this chapter is for you. Through this chapter, you'll learn the ins and outs of connecting with investors and building your financial network. From identifying the different types of investors and understanding the various forms of funding to crafting a financial plan and anticipating potential questions from investors. This chapter will provide you with everything you need to know to successfully navigate the world of business financing. So grab a cup of coffee and let's get to it. Boost your business with an investor network. Make the leap to success. Connecting with investors and building your financial network. Gaining the financial support from an investor can be a crucial factor in launching and growing your business. But how can you connect with investors and build a financial network that best suits your needs? First, you'll need to be aware of the different types of investors. Angel investors are typically individuals who contribute capital to startups in exchange for ownership equity. Alternatively, venture capitalists are firms that specialize in raising capital to invest in later-stage businesses. Private equity firms also provide capital, but typically after the business has been established. Banks are also an option, but generally require extensive due diligence. When it comes to the funding, there are a few options to consider. Equity funding is when an investor acquires a share of the company in exchange for capital. With debt funding, the company issues debt, usually in the form of a loan, which must be paid back with interest. There are also convertible notes, which are short-term loans that can be converted into equity after a pre-agreed-upon period. You'll also need to consider the different approaches to take when approaching investors. Cold emails can be used to connect with potential investors, but you should be sure to follow up consistently. Attending conferences and networking events can also be beneficial for connecting with more experienced professionals. It's important to take note of the key aspects to consider when choosing an investor. A track record of successful investments is a great start, as this will demonstrate the investor's knowledge and experience in the field. It can also be useful to assess how much knowledge and resources the investor has, and whether they understand your business goal and vision. Once you've identified potential investors, you should create a comprehensive financial plan. The plan should include a cash flow statement, profit and loss statement, and balance sheet. You should also conduct financial analysis to ensure sustainable and scalable growth. Evaluate the cost of goods sold, break-even analysis, budgeting, and ROI analysis. Finally, make sure to present the plan professionally to ensure it communicates your business potential for success. It's also a good idea to research existing investors and their preferences. Understand an investor's profile by looking at their types of investments, portfolio companies, and experience. You should also establish which strategies are best for connecting with potential investors and determine which qualities an investor should possess to best suit your business. When presenting to an investor, there are certain documents you'll need to provide. These documents include a certificate of incorporation, shareholders agreement, partnership agreement, investment agreement, accounts and financial statements, tax returns, business plan, pitch deck, equity compensation plan, and any other documents an investor may require. Finally, you should anticipate questions that investors may ask and prepare responses in advance. Common questions can include background information, financial projections, and strategies for achieving success. Your answers should be structured properly in story-like format with evidence-based data. Your goal should always be to demonstrate potential, emphasize strengths, and prioritize the investor's goals. Gaining investor support and building a strong financial network is an essential step in starting your business. By understanding the different types of investors, funding options, approaches to take, and documents needed to present, you'll be able to make the most of your business opportunities. Different types of funding. When starting or growing a business, the need to secure funds is a critical component, and there are various types of funding available to entrepreneurs, from angel investors, venture capital, crowdfunding, and other forms of financing. All of these types of funding have different advantages and drawbacks, and depending on the circumstances, certain types of funding can be more beneficial than others. Angel investors are individuals who invest their own funds in a business in exchange for equity. This type of funding is typically for startups and can provide financial support and guidance, as well as access to their networks. Angel investors also have the advantage of being more flexible in terms of their funding structures and timeline. Venture capital, on the other hand, is more focused on later stage companies that have already achieved some level of success. Rather than providing a loan, venture capitalists typically offer a stake in the company in exchange for a percentage of profits. They usually provide more funds, but require a higher degree of oversight and control. Crowdfunding is also an option where a business's projects, activities, or objectives are funded by a large number of people, usually over the internet. The most common types of crowdfunding are donation-based and reward-based. With this type of funding, businesses can tap into a wide network of potential investors and receive funds for a specific project or goal. Other forms of financing that businesses may opt for include secondary markets, private equity, and initial public offerings (IPOs). Secondary markets involve the buying and selling of existing shares, while private equity involves selling a certain percentage of the business to a private investor. IPOs involve the offering of shares to the public for the first time, and is usually done by larger, more established companies. Each of these types of funding involve different levels of risk and offer different levels of return. So it is important to research each option thoroughly and choose the most suitable funding type for your business's needs. Creating a financial plan and presenting it professionally. Creating a financial plan is a key step for any aspiring entrepreneur who wants to get their business off the ground and start making their dreams a reality. Having a well-crafted financial plan demonstrates to potential investors that you have the knowledge and experience to properly manage a business. It also provides a roadmap for your business and outlines strategies for making your business successful. The first step towards creating a financial plan is determining the components that should be included. A financial plan should include cash flows, a profit and loss statement, and a balance sheet. All of these documents should be used to gain an understanding of the finances and operations of the business and expenses for the business. And the balance sheet will show the business's assets and liabilities. Once the components for the financial plan have been identified, it is important to conduct an analysis of the data. A financial analysis can be done by examining the cost structure of the business, calculating the break-even point, and projecting future profits or losses. This analysis will show potential investors the expected financial performance of the business. In order to make accurate financial projections, it is important to be able to read financial statements accurately. A balance sheet will provide information about the company's assets, liabilities, and equity, while an income statement will track the revenue and expenses for the business. It is important to understand the difference between the two statements and how they can be used to track performance. When creating a financial plan, it is also important to properly allocate resources. This plan should include a budget so that the company can properly manage its expenses. Additionally, it is helpful to conduct a return on investment (ROI) analysis to determine which activities are providing the most value, into which activities should be prioritized for maximum returns. Finally, it is important to be able to present the financial plan in a professional manner. When preparing for a presentation to potential investors, it is helpful to use storytelling techniques to communicate the plan. Additionally, it is important to understand the needs and goals of the investors, so that the presentation can be tailored to meet those expectations. In conclusion, creating a financial plan and presenting it professionally is an important part of launching a successful business. A well-crafted financial plan will demonstrate to potential investors that the business has the knowledge and experience to be successful. It is also important to be able to read financial statements accurately, allocate resources effectively, and present a professional presentation to potential investors. This will help ensure the business is successful and can attract the right type of investors.